Jeff, thank you so much for being with us. So everybody's trying to figure out what the Fed is going to do. I'm quite sure the Fed included is trying to figure out what they want to do. Rick Reeder of BlackRock earlier said to us, the Fed wants to be able to cut here and probably cut a couple of times. Do you agree with that assessment? And I guess, will they then be able to cut a couple of times given the recent data?
I agree that they do seem to be anxious to get started on cutting rates. It looks like they're positioning to do so at the first time it's credible for them to do so. But I think they're out a little bit over their skis. And I think they went a little too far last year in encouraging views about rate cuts this year. And I think this recent stretch of inflation data over the last 3 months is a good reason why they would have stood themselves in better if they'd been a little more cautious last year. It still is quite plausible that inflation sticks right around here. This would be 3 to 4%. 3.5 to 4 on the CPI, maybe 3 to 3.5 on the PCE core. And if it just persists at this level, they could easily not get any rate cuts in this year at all.
What needs to happen, Jeffrey, to get inflation back to target? Does unemployment have to ramp? Is that what needs to happen?
No, it doesn't. But policy needs to be restrictive enough. The key with monetary policy, as always in a situation like this, is encouraging people to delay spending because it's the excess of spending over the economy's capacity that drives inflation. You don't need to reduce spending so much as to cause a recession, but you do need to restrain it enough. And the signs are that there's a good chance that Fed policy isn't terribly restrictive right now and isn't going to do the trick in getting inflation down. The way to think of this is that there's a real interest rate that's relevant to people's incentives to delay spending. And what's relevant to what goes into that calculation is the current inflation rate, not what the inflation rate's going to be at the end of the SEP in the long run when inflation's back down to 2%. With inflation running around 3.5% right now, I think there's a good case can be made that policy is not terribly tight right now.
Well, even if policy isn't terribly tight right now, I guess there's also always the perennial question of how effective it would be even if it were tighter. In other words, the things that we're still seeing increase in price are maybe things that aren't as affected by rate policy, if you're talking about things like medical costs or healthcare spending, for example.
Well, there's always some components of the basket of goods that consumers and businesses purchase that go up more rapidly than others. So there's always relative price changes. But you want the overall level of prices, the average, the value of money over time to be stable. And sure, driving up real interest rates might not cut into what people spend on healthcare and might not diminish the extent to which medical prices are exceeding inflation. But there's going to be something that people cut back on and firms cut back on. And so, yeah, something will give and the overall inflation rate will fall.
I've heard some folks, Jeffrey, seem to suggest maybe they take some comfort in that the PCE is somewhat lower. What do you make of that argument?
Well, so there's methodological reasons why they're different. And so, yeah, you got to take that translation into account. But even with that, with today's PPI, it looks like the next core figure is going to be at around 3% on a month over month at an annual rate. So it looks like over the last 3 months, we've had core inflation measured by the PCE at above 3%. And that's not a good number. That's not nearly close enough to 2% to give them comfort. And it's worth pointing out that they had this stretch of 6 months of good inflation numbers in the second half of last year. We've had 3 months of adverse inflation numbers. The good numbers were the consequence of goods prices coming down. But service prices just haven't. Service and price inflation hasn't moderated to the extent they want. It's driven by wage setting, and wage rates are still going up at a rate that isn't consistent with inflation coming down to 2%. They may fall, but that's an open question. And with the labor market tight and tighter than expected at this point, it seems clearly plausible that inflation sticks around 3% rather than falls to 2%. And I think they need to prepare people for what the Fed would do in that case. And I think it would be better for them in the longer run if they back away from this language about getting how many rate cuts they're going to get in this year, whether they're going to start cutting rates this year. The end of the year is a bit of an artificial horizon after all.
Well, and also, is there any chance that the Fed would actually pull on some of its other levers, its balance sheet, for example? If you think that policy isn't sufficiently restrictive right now, is that one way that they could do it without making a change to rates?
I'd hope that they'd keep up a healthy rate of rolling off the balance sheet. They seem at the last meeting they discussed whether to reduce the rate at which that's rolling off. I don't see the necessity of doing that. But at the end of the day, the balance sheet is something of a sideshow. The effects are likely to be small, uncertain, imprecisely estimated. They've got a ways to go before balance sheet reductions would provide much of a disinflationary effect. I think the main game in town here is the interest rate setting.
Right, definitely, and the communication about it. Jeffrey Lacker, thank you so much. Appreciate it.
Great, thanks.